Hello, my name is Tom Clark and I'm an associate in the corporate department here at Bristow's. I'm going to talk briefly today about convertible loans. I'll describe what they are, a few of their key terms, and why they're used to fund early stage companies. So, what is a convertible loan? A convertible loan is similar to any other debt in that the amount borrowed under a convertible loan is repayable at some point in the future, together with any interest that may be payable in respect of the loan. The crucial distinguishing feature of a convertible loan is that the lender or investor has the right to convert the amount of the debt into shares of the borrowing company when one of a number of specified events occurs. In the context of growth companies, the typical events on which the loan becomes convertible into equity are the completion of the company's next round of equity fundraising and an exit by way of sale or listing. The number of shares in the borrowing company that the investor will acquire on the conversion of the loan is usually calculated by reference to the price at which shares are issued to the investors in the fundraising, if the triggering event is a funding round, or the sale or listing price per share if the company is sold to a third party or listed. So, what are the main commercial terms? From both the company and the investor's perspective, one of the most important terms that will need to be agreed is whether a discount will apply on conversion of the loan, and if so, how great that discount will be. The discount operates to reduce the price per share at which the investor converts their loan into shares in the borrowing company. So the greater the discount, the greater the number of shares that the investor will acquire on conversion of their loan. Discounts of 10 to 20% are not uncommon. Clearly, another important commercial term will be the amount of interest which is payable in respect of the loan. Due to tax complications, the interest on convertible loans does not usually convert into shares when the rest of the loan does, and is only payable if the loan is redeemed in cash. The parties will also need to agree the events which will trigger the repayment of the loan, rather than its conversion into shares in the borrowing company. One of these events will be the company becoming insolvent. Another will often be a failure by the company to raise a target amount of additional capital from third parties via an equity round within a defined time period. One right an investor may seek is to guarantee percentage shareholding in the borrowing company at the point the loan converts on the next funding round. From an investor's perspective, this is attractive because if the company's valuation is very high at the next funding round, the investor's loan may convert into a smaller stake in the company than anticipated at the time the loan was made. This is often resisted by the existing shareholders and the borrower, not only to protect their own shareholdings, but also because this may make the company less attractive to potential investors in the next round. Why are convertible loans used? From a borrowing company's perspective, a loan can be comparatively quick and cheap to put in place compared to raising funds by issuing shares. This is one reason why convertible loans are often made by existing investors to a company in between equity funding rounds to provide a company with enough cash to see it through to the next funding round. This is often described as a bridging loan. For companies that have yet to carry out their first equity fundraising and may indeed not have any trading history on which to base evaluation, using a convertible loan rather than issuing shares to raise funds allows the existing shareholders of a company to delay negotiating the value of their company with potential investors until there's more information available to support that valuation. From an investor's perspective, a convertible loan provides some of the benefits of both debt and equity investment. Before conversion, the investor will rank above the shareholders of the company if the company becomes insolvent, and the investor may be able to redeem the loan in cash together with any interest repayable. However, if things go well for the company and the valuation increases, the investor will often be rewarded for the risk they have taken at the next funding round by virtue of their conversion discount. There are a couple of downsides to convertible loans of which investors should be aware. The first is that SEIS and EIS relief are not available in respect to the shares that result from the conversion of a loan. There are also tax complications related to the conversion of interest on a convertible loan into shares that will need to be considered at the time the loan is made if conversion of interest is desired by the parties.